What if I told you that every single major financial crash of the last century, we're talking 1929, the dot-com bust, 2008, what if they all followed the exact same five-stage playbook, a pattern that insiders know, but that's pretty much hidden from the rest of us? Well, according to our source material, that pattern is playing out again, right now.
So, picture this. It's September 5th, 1929. A relatively unknown statistician named Roger Babson gets up and says these words. And you know what happened? People laughed. The press called him a fool. The most famous economist of the day just completely wrote him off. And then, just 47 days later, the market began the most devastating crash in American history.
And this is where it gets really stark. You had the celebrated Yale economist Irving Fisher, the guy who famously said stocks had reached a permanently high plateau. He lost everything. I mean, everything. Then you have Babson, who just looked at his own data, prepared for what he saw coming, and made a fortune.
So here's the key takeaway. Babson wasn't just lucky. He wasn't guessing. He was following a pattern, a specific set of conditions that he saw building up in the market. And the source for this explainer argues that this very same pattern is what we absolutely need to be paying attention to today.
So what is this pattern? Well, our source calls it the five-stage crash pattern. And the claim is that this is the hidden sequence that has shown up right before every single major collapse for the last 100 years.
Okay, so here's the roadmap. It starts with the credit explosion, then a concentration trap. After that, you see the smart money exit, followed by a liquidity illusion, and it all ends with the final piece, the trigger. We're going to go through each one and see exactly how they stack on top of each other.
All right, let's start with the first two stages. These are all about how the fragility gets built into the system in the first place. You know, this is where the vulnerability is created, long before most people even have a clue there's a problem.
So stage one is always the credit explosion. And look, forget what you hear about greed causing crashes. The source says it really all starts with debt. When the amount of borrowing grows way, way faster than the actual economy, you get this really dangerous feedback loop. People borrow money to buy assets, which pushes the prices up, which then makes them feel richer, so they borrow even more. It's a cycle that makes the whole foundation of the market incredibly shaky.
And what's fascinating is how the type of debt changes, but the pattern stays the same. Back in the 20s, it was people borrowing money to buy stocks. In 2007, it was no money down mortgages. And today, the source argues it's basically all of the above. Corporate debt, government debt, hidden leverage, and as a percentage of the economy, it is higher right now than at any point in history.
Just to put a number on it, that's $34 trillion. And that's just U.S. government debt. I mean, the sheer scale of stage one today is something we've just never seen before.
Now let's move on to stage two, the concentration trap, because this is where all that debt creates a new problem. See, the source is really clear. High prices by themselves don't cause a crash. What does cause a crash is when all that value gets piled into just a tiny number of big names. The whole system becomes a house of cards resting on just one or two legs.
And this chart just says it all, doesn't it? Right now, the top 7 stocks make up over 30% of the entire S&P 500. So here's what that means for you. You might think you're buying a diversified index fund in your 401k, right? But you're not really buying 500 companies. You're actually making a huge concentrated bet on just a handful of tech giants. If one or two of them go down, they take the whole market and your safe investment down with them.
Okay, so now we get to the next two stages, and these are the really subtle ones. The almost invisible warning signs that the ground is starting to get unstable, even while everything on the surface looks totally fine. Stage 3 is the smart money exit. And honestly, this is the one that's just infuriating. It's when the insiders, we're talking CEOs, billionaires, the people who have the best information, they quietly start selling their stock. They don't make a big announcement. In fact, they'll often go on TV and tell you to stay invested, all while they are silently heading for the exits. And who are they selling to? To the unsuspecting public, to people like us.
And the data right now is pretty stark. Corporate insiders are selling their own company's stock at a historic, record-breaking pace, while the amount of buying is incredibly low. The source presents this as one of the clearest signals you can get. The people who run these companies are cashing out.
Which brings us to what might be the sneakiest stage of all, the liquidity illusion. Okay, think of liquidity as the oxygen of the market. It's the ability to sell something easily without crashing the price. On the surface, in stage 4, everything looks great, prices are still high, but underneath, that oxygen is slowly being sucked out of the room. That ability to sell is just disappearing. And when a panic hits and that liquidity is gone, well, there's no way out. The fire exits have all been boarded up.
And you don't have to look far to see the signs of this squeeze. First, the Fed slams on the brakes with the fastest rate hikes in 40 years. Then, last year, 3 major banks just collapsed in a single week. And now, even the U.S. Treasury market, supposedly the safest, most liquid market in the world, is showing serious signs of stress. The oxygen is definitely getting thin.
So if those first 4 stages are all about setting the trap, stage 5 is what finally springs it. Let's look at this last piece of the puzzle, and more importantly, what it means for you.
Stage 5 is the trigger. And here's the most important thing you have to understand about it. The trigger doesn't cause the crash. The real cause was everything in stages 1 through 4. That's the fuel, the giant pile of dynamite. The trigger is just the lit match that gets tossed on top. So what could it be? Who knows? A geopolitical shock? Another big bank going under? A crisis in commercial real estate? Or maybe the most likely thing is something that nobody is even talking about yet. The point isn't to guess the trigger. It's to realize that when the system is this fragile, any trigger will do the job. And here's the kicker. The source material claims that historically, once those first 4 stages are locked in, the trigger, that lit match, tends to show up within the next 12 to 24 months. Which brings this whole thing full circle, right back to the beginning. The choice we all face today is the exact same one that separated Roger Babson from Irving Fisher. Do you respect the historical pattern and prepare for what seems to be coming? Or do you ignore the signals and just hope for the best?
So let's make this really personal for a second. I'm not just talking about a trading account. Think about your 401k, your pension, the equity you have in your home. How much of your family's actual financial security is totally dependent on prices just staying up here at these record highs?
Let's just ask the ultimate stress test question. If the market dropped by half tomorrow, which is similar to what we saw in 2008, would you and your family be okay? Or would it be a truly devastating blow to your retirement and all of your future plans?
Look, in the end, no one is going to ring a bell at the top. According to this analysis, the pattern is the warning. The same signals that came before every major crash of the last 100 years are here again. Now you know the pattern. The only question left is, what are you going to do about it?